All right, so welcome to phase 2 of the institutional course. And this phase will mainly be more about theory, diving deeper into not so much the charts, but really the mindset, trading plan development, and other things that are keys to becoming a consistently profitable trader and are something that everybody needs to know and understand. So today we're going to be jumping into trading psychology. Trading psychology, what it is, why it's important, and how to master your own psychology so you can become a consistently profitable trader. Okay, so why is trading psychology important? Because trading is 80% psychology, and a lot of people, when they try to learn how to trade, they think, okay, I'm just going to learn all technical analysis, all fundamental analysis. I'm going to learn every single thing about the markets, and ultimately they just become worse and worse. And they don't realize that if their psychology is not in check, that no matter how much they learn about the markets, they will never become profitable. So it's up to you to have a deep understanding of your own psychology, your own tendencies, your own bias, what makes you tick, why are you taking certain trades, because your psychology has an impact on every single trade you place. Whether it's negative or positive, every single trade you place has your psychology built into it. So it's important to understand your own psychology and what you're thinking and why you're thinking it before you even enter a trade. Okay. An emotional trader is never profitable long term. Okay. Now, if you are prone to getting frustrated, if you are prone to over trading, over leveraging, really not trading properly, then you are going to have a very hard time becoming profitable. Because if you look at, for example, if you look at AI robots, trading robots, what they do is they just take the same trade over and over and over again. And those robots are not going to win every trade. They're going to lose some. But they take every single trade that matches the parameters that are defined by the algorithm, and over a series of trades, those bots are able to make money. So your goal as a trader is to get as close to that, actually, let me correct that, is to become an absolutely mechanical trader and do the exact same thing as those trading robots. You need to train yourself to study the market, learn how the market moves, study yourself, and take every single trade that matches your analysis of the market, and over a series of trades you will become profitable. It's not on a trade by trade basis. It's not, out of every 3 trades. I'm talking over a series of 10, 15, 20 trades, whatever it is. I would say minimum 10. You need to find out your edge, or what trading style you like, what works for you. We're going through, in this course, I'm teaching you day trading, right? Because that's personally how I trade. And you're going to learn that if you take every single trade that matches your analysis that you've outlined, and your analysis gives you an accuracy of around 70%, then you are going to be profitable. But what happens with 99% of traders, and this is why there are very few profitable traders in the world, is because they don't take every trade that matches their analysis. Sometimes they take trades that look a little bit sketchy or aren't really as clean, and they take them anyways and they lose them. And in their mind, they know they shouldn't have done it, but they do it anyways, and ultimately it lands them with a loss. Okay, so anything that happens in your life can affect your trading. So whether it's an argument with a spouse, you had a bad day at work, you're tired, the weather outside, right? What you ate for breakfast, if your head's not clear, if you didn't do your morning meditation, and every single thing that happens in your life will affect your trading. Whether you trade at night, you come home from work and you trade, and somebody cut you off on your way to work. Right? All these little things will have a big impact on your trading, and you'll be able to see it if you're not doing well in your personal life, if you're not taking care of yourself, if you're not eating properly and feeding your body good nutrition, and you're not taking care of your own mindset, you'll notice in your trades they're not doing well. And it's because things that happen in your life come into your trading and they affect it. So you need to really monitor and pay attention to how you feel, how you're thinking, and how you act in accordance with your trading. Because if you find out that you are not trading properly because there's something else going on in your life, you suddenly realize, like a light bulb goes off, like, okay, now I'm starting to see. If you have a bad week at work and your trading's bad, you'll see the correlation there. You'll see your trading is off, and it's not your trading, because let's say your trading skill stays the same, but depending on how your week is going, your trading might be different. Now, does that happen for every trader? No, it doesn't, right? It doesn't happen for traders that have learned how to handle this and adjust themselves to the market, or even take a week off when they know their mindset's not right. But if you are still in the learning process and you're trading every day and you want to learn, and you're trading almost every day, you will notice if you have a bad day, a bad week, it will come out in your trading just the same. All right, and you need to be able to accept your own mistakes as well. It's not the market's fault. It's not my fault. It's not your mom's fault. It's not your spouse's fault. It's not the person that cut you off on the road. Every single trade you take is your responsibility, and it's up to you to own your mistakes, to learn from them, and to grow as a trader. It's not to blame the market. It's not to blame anybody else. It's only to blame you. Right? Every loss is your fault, not the market's. And emotions are the number one reason 96% of traders fail. Every truly successful trader has mastered this skill. All right, so an unemotional trader is completely detached from the outcome of their trades. Okay, they accept the risk of every trade they put on, and they are aware of their own thought patterns and behaviors. So this is where you really need to pay attention and learn and study your own thoughts, your own feelings, your own psychology, and recognize when that's affecting your trading. You also need to make sure that before you place any trade, every single trade you place has the risk absolutely defined. You don't just jump into a trade and throw a one lot on there without even knowing where you're going to put your stop loss yet. Because as soon as you do that, your emotions have affected that trade, and that trade is very, very likely to be a loser. So we already talked about emotions in trading. So the two biggest ones are fear and greed. So fear, and types of fear. Fear of missing out. So let's say price comes down and you're looking to take a buy and it starts running away, and you get scared that you just missed the trade. You don't want to miss it. It's going to leave without you. So you jump in. Right as soon as you do that, your emotions and your psychology and your feelings have affected that trade, and that trade is almost guaranteed to lose. If you miss the trade, you miss the trade. You do not chase it. You don't chase price. You let the market come to you, because there are setups almost every single day. And in this course, you're going to learn how to spot them, where to see them. But if price starts moving away and you jump in early, what's going to happen is you probably haven't taken the time to pull out a position size calculator, calculate your position. So, okay, price is here. I want to put my stop loss down here. It's, let's say, 20 pips. You probably haven't done that. So when you jump into that trade, you're either going to put a tiny little bit less leverage on than the buy that you would have taken lower than where the price is, or you're going to put the same leverage on, and now you're over leveraging. And now your emotions are in that trade, and every single pip of drawdown is going to make you feel much more strongly about losing and much more fear than the original trade would have. So fear of being wrong as well. This is where you need to learn how to trade, learn the analysis, learn the fundamental analysis, study all the technicals, understand the market, and then take every single trade that matches the setup that you've outlined. Because if you're scared of being wrong and you mark up all these charts on your trading view, and then you wake up in the morning and then they're all those trades that you could have taken that you just marked up, they all hit, but you're scared to put a buy limit or a sell limit there because you didn't want to be wrong. Your emotions are affecting your trading again. So then you need to take a step back. You need to either do some work in your analysis and your edge, what you look for in a trade, and your psychology and how you think about the markets. The third one is fear of losing money. Right? We all have that fear of losing money. And it's a very, very big one, and it causes people not to invest. So the fact that you're here, you've invested your own money to learn this, already shows that you've already taken the step in the right direction. Okay, I'm not going to sugarcoat things. You are going to lose money in the learning process. We all do. However, you need to be able to master that fear. So if you're in a trade and you have a little bit of drawdown, you need to completely accept the risk of the trade before you put it on. You need to be completely unattached to whether it wins or loses, and train yourself not to be scared of losing money. So fear can cause you to chase the price, like I mentioned. Close your trade early. So the trade starts going up into profit, and then you're happy, and then it starts coming down, and while it's coming down, you quickly close it, and then it flies up another 30 pips. That's your psychology again, so you need some more work on it. Over leverage. Fear can cause you to over leverage. Overtrade. Break your risk management parameters, and ultimately blow your account. All right, greed. Going into greed. So greed can cause you to chase price. Hold on to your trade for too long. So a price has clearly gone in the right direction for you, and instead of taking your profits, you hold on to it because you want to make more, and then it comes all the way back down and stops you out. That is your psychology. That is greed. That's your emotions affecting your trading, and you need to go back and you need to work on your emotions again if that keeps happening to you. It can cause you to over leverage. You want to make more money quicker. You want more money, so you over leverage. You put twice the leverage on. You start, as price is moving up, you start throwing more and more buys in there. That's greed. That's your psychology. You need to work on your psychology because this should not be happening with a proper professional trader. All right, so euphoria from winning trades can cause you to overtrade. So let's say you've won the last 3 trades and you're feeling good. You're like, you know what? I know I'm good at this. I'm going to put in another trade. That is the trade. As soon as your emotions, right there, your psychology and your emotions, that euphoria is affecting your trading, that trade is the one that you will over leverage on, and that is the one that you'll lose, and you'll lose everything you just made. So pay attention to that. Greed can cause you to break your risk management parameters as well. So let's say your risk management parameters are, I'm going to risk 1% per day, and I'm going to have 2 trades that are 0.5% each. And let's say you lose those 2, and then you get greedy and think, I can make it back. So then you put another 1% on a trade, and then you lose that one. And now instead of losing 1%, you lost 2% for the day, which is double what you intended. It can ultimately cause you as well to blow your account, which is not what we want to happen. All right, so the Wall Street cheat sheet. This market cycle is pervasive in every single market you will ever see. This schematic right here, this whole up and down and bull run and bear run, this is seen everywhere. It's seen as stocks, crypto, commodities, forex, you name it, it's there. But I want you to take a minute for a moment. Okay, and you can pause the video. Where have you seen something like this? Okay, so you can go ahead and pause the video now. All right, so if you did pause the video, then good for you. If you didn't pause the video, you just listen to me stop talking for 3 seconds. But the schematic, the Wall Street cheat sheet, is seen in Bitcoin. So this screenshot right here was taken as of August 18th-ish, about 3rd week of August. And the Wall Street cheat sheet is a perfect example of Bitcoin. And Bitcoin, as if many of you know, had a massive crash. And it had a big drop. And a lot of people were liquidating their crypto. They were getting out of the market. They were scared. They were nervous. They're thinking, oh my God, I'm losing all my money. I need to get out. And that's their emotions. That's because they invested what they're not willing to lose. So when they start losing it, they pull it out. And then when price starts going right back up, right now, as of this recording, price is at 56K versus 45. It's gone all the way back up now. But people let their emotions dictate their actions in everything in life, but in trading especially, and ultimately it's the downfall of every trader. Now, does it look any more familiar? At the bottom we have disbelief, then hope, then optimism, belief, thrill, euphoria. Right at the top, how many people do you know that bought Bitcoin at 60,000? I know quite a few. It's going up and it's going up and it's going up, and they're thinking, oh, okay, I need to get in here. Look how high it is. It just broke all-time highs. They buy it and boom, it comes crashing down, and then they start selling and they've lost hundreds, thousands, tens of thousands, hundreds of thousands of dollars. Then we have, on the way down, complacency, anxiety, denial, panic selling, capitulation, anger, depression, and then right there at depression, where it starts to run back up, that's where everybody that is not experienced in the market or let their emotions dictate their trading liquidated their crypto portfolios, and then boom, starts completely rallying all the way back up. And this whole drop was engineered on purpose to induce that exact same psychology. The Wall Street cheat sheet was created right inside of Bitcoin to liquidate all of the emotional traders, all of the people that are scared to lose their money. And for 6 weeks it accumulated, but that weekly low right there where disbelief is held. And this is where institutions like the banks, hedge funds, central bank were all getting into the market right here. And you can see news articles on it. You can see lots of details about the banks getting in there. So the banks are buying Bitcoin up all right there, and everybody else is liquidating their crypto. You need to observe the masses and do the opposite, because what will happen is you'll start liquidating your crypto. It'll go right back up, and then you'll realize, wow, I was wrong. I should have had a better understanding of the market. I should have been patient, and I should not have let my psychology dictate my trading. All right, so some resources for psychology. On YouTube, you can find How to Think Like a Professional Trader by Mark Douglas. Very, very good series. There are 4 parts. So parts 1, 2, 3, and 4 are very valuable. I still listen to these almost on a weekly basis. I do come back to them. Very helpful. You should consider them mandatory to become a profitable trader, to listen to Mark Douglas. Trading in the Zone audiobook, also Mark Douglas, on YouTube for free. And the Disciplined Trader audiobook, also by Mark Douglas, also on YouTube for free. If you like physical copies, such as myself, the Trading in the Zone book and the Disciplined Trader are available for purchase. And let me warn you, they are not cheap. They are smaller books compared to lots of books. However, they are 4 times the price. And I'm telling you now, as trading becomes more and more popular, and since Mark Douglas has passed away, rest in peace, these books are only going to go sky high in value. Okay, so if you don't have a physical copy of these books, I would highly recommend getting one. One of each. But personally, I do enjoy Trading in the Zone very much. They're both very valuable, so do buy both. But these resources are something that you need to go through before you move on to the next step. So make sure you go through these, study, learn, and I will see you in the next video.